All right, so chapter 9 and 10 are all about partnerships and different aspects of forming and operating partnerships from a taxation perspective, of course. All right, so remember that when we talk about partnerships, we're talking about any kind of entity that's taxed like a partnership, so that we're talking about flow-through entities. So remember that income is not taxed at the entity level like it is with a C Corp. It's a flow-through entity, which means then that the income flows through to the owners, okay? And so within that, you've got this aggregate and entity concept, right? The entity approach treats partnerships as entities separate from their partners, and the aggregate approach treats partnerships as an aggregation of partners' separate interests. Okay, so remember that a partnership is kind of the culmination of both of those things. Okay, so how do you form a partnership? Okay, well, what about when you contribute things to form a partnership? All right. So depending on the transaction, realized gains and losses from the exchange of contributed property, for a partnership interests are either fully or partially deferred for tax purposes. So it's very similar to allowing a tax deferral when a C corporation is formed, okay? And that is kind of based on this aggregate theory of partnership taxation, okay? So generally speaking, neither partnerships nor partners recognize a gain or loss when they contribute property to partnerships, okay? And so what about some general rules? So, okay, I'm going to position that. All right. So generally speaking, oops. So the general rule essentially encourages contributions with built-in gains, okay? Because what does that mean? Well, a built-in gain is your fair market value is greater than your basis, right? So if we tax defer gains, right, then that's going to encourage contributions with built-in gains. At the same time, if these impacts are tax deferred, it's going to discourage contributions with built-in losses. So a built-in loss would be a fair market value less than a basis, right? And it would discourage that type of a contribution, because if you don't get to recognize your loss in the current year, well, that is not a beneficial situation for the taxpayer. All right, so with partnerships and any flow-through entity, we really have to pay attention to our basis, okay? And so essentially what you're required to do is at every year, at the beginning of every year and the end of every year, you're required to have a tally essentially of every partner's basis in their interest in the partnership, okay? And so if we look here, all right, our initial basis, all right, if you don't have any debt, is the sum of the tax basis of property and cash contributed by the partners, okay? And then what about if there is debt, okay? So each partner also includes their amount of debt in calculating their basis. Okay? Now, one thing I wanted to mention, I'm going to reposition here and kind of focus in. So there's a word here that we need to focus on, and it's this. I'll do the whole concept really. So outside basis. Okay. So when we talk about partnerships, we have inside basis and we have outside basis. All right. Inside basis is the basis in the property held by the partnership. Okay, so that's the inside basis, right? The property inside. And then outside basis is the basis in the partnership itself. Okay, so you have to think about those two things slightly differently. You've got an inside basis and an outside basis. All right, so there are two general types of debt. We have recourse debt, and then we have non-recourse debt, okay? So recourse debt is defined here, and non-recourse debt is defined here, okay? What I want you to pay particular attention to with the non-recourse debt is it's usually allocated according to the partner's profit sharing ratios, okay? Lots of times when you set up a partnership, you will have you can share amongst the partners, right? Profits and capital, okay? All right, notice that non-recourse debt is not allocated based on your share of capital. It's based on your share of profits only, okay? So typically, so that's important to point out. All right, and this just shows you how recourse debt versus non-recourse debt is allocated. Okay, so all right, some other items that we need to pay attention to. All right, so if a partner is contributing property secured by debt, okay, that partner is going to have to recognize a gain, and this makes sense, when the debt relief exceeds the partner's basis, okay? Also, pay attention to the holding period of the property that was contributed, because now the partner's holding period in a partnership interest depends on the type of property contributed. So if we form a partnership tomorrow and I contribute long-term property that was long-term property to me, then my interest in that partnership is long-term property, even though the property has not been in existence for a long period of time, okay? And so this third bullet kind of goes along with that concept that your basis and holding period in contributed property carries over to the partnership, okay? All right, so what happens when you contribute services? So say we're going to start a partnership, and instead of contributing cash, I'm going to contribute my accounting services, okay? So then a capital interest represents a current economic entitlement, all right? So if you are a service partner, if I were not contributing property, only services, all right, and I receive a capital interest, then I have ordinary income in the amount of that capital interest, okay? And then you might ask yourself, what's the tax basis, right? The tax basis in that capital interest of the partnership is based on the amount of ordinary income that I would recognize. Okay? Now, that's for a capital interest. Remember, you can have two types of interests in a partnership, a capital interest or a profits interest. Okay? So it's important to remember that a profits interest does not give you a liquidation value. Okay? So if, 2 weeks from now we decide to sell our partnership and I have a capital interest, then when we sell that partnership, I'm going to get some of the proceeds from the sale. Okay? If I only have a profits interest, well, you can think of profits interest kind of as a current interest. Each year you get your profits out or your losses. But then when you go to sell that partnership, if you only have a profits interest and that partnership is liquidated, you're just done. You don't get any share of the capital that then is distributed as a result of the sale of that partnership. Okay, so there's no liquidation value for a profits interest. Okay, now if you only get a profits interest, all right, you have to pay attention to whether we're talking about someone who has contributed service or whether we're talking about someone who has contributed property. Okay, so a service partner is someone who has contributed services. A non-service partner is someone who has contributed property. Okay, so at a profits interest, a service partner will not recognize income and non-service partners will not receive deductions if all they have is a profits interest. And we're talking about during the acquisition. I should write that specifically. Okay, so that was an important little addition there. All right, so one interesting difference between partnerships, and I should say all entities that are taxed like partnerships, is this little piece right down here. Okay, so you can see the tax basis formula right there. Okay, but organization and startup costs, all right, are capitalized rather than expensed. Okay, so that is a very important difference. Okay, so the partnership can elect to amortize or capitalize organization costs and startup costs. Syndication costs, however, are different. The difference is organizational costs can either be deducted or capitalized, whichever is more beneficial. Startup costs can be deducted or capitalized, whichever is more beneficial. Most of the time, they're capitalized. But syndication costs must be capitalized. Okay? All right, here this is a great slide that gives you kind of the overview of what happens when you contribute property, when you contribute services, and then this is what happens when you purchase a partnership interest as opposed to contributing property or contributing services. Okay? And you can see here that that's your cost basis, right? So whatever you paid for the partnership plus your percentage of the debt allocation, and that your holding period begins on the date that you purchase that interest, all right? You don't get any kind of holdover or carryover holding period, okay? All right, so what about all of your tax elections? Overall accounting method, whether you expense or capitalize, right? All of these things are made at the partnership level. Those decisions are made at the partnership level. Okay. And typically, partnerships can use the cash method unless they have average gross receipts larger than a certain amount. Okay. All right. So, how do we determine a partnership's year end? Well, there are a couple of steps. So, the first question is there a majority interest tax year? If yes, then you use that tax year. So, for example, if all of the partners in the partnership are individuals, what's the majority interest tax year? Well, it's a calendar tax year. It's December 31st. Okay. If no, then you have to ask if the principal partners have the same tax year end. Okay. If they do, great. Use that taxable year. If they don't, then you have to use this least aggregate deferral concept. Okay. And what that means is, let me write this down, least aggregate deferral means that you choose the tax year that provides the smallest amount of aggregate deferral, okay? Which means you are going to mathematically weigh each partner's month deferral. So you mathematically weigh each partner's month deferral, and then you sum up the months to figure out the aggregate deferral. And the summation with the least amount of aggregate deferral, that's how you choose the tax year. All right, so what about partnership operations? How do we report those ordinary business income and loss items as well as separately stated items? All right, so we have ordinary income and loss, and then we have separately stated items. And what do we need to focus on? Well, we need to focus on these separately stated items, okay? Because separately stated items are pulled out of the calculation of ordinary income and loss because they are allocated separately to the partners. And the reason they're allocated separately to the partners is because they are going to be taxed uniquely based on the partner's situation. So a great example, capital gains and losses, dividends. Okay, why are those great examples? Well, okay, think about two individuals. Say there are two individuals who are partners in a partnership, and one is a very high income individual because they have, I don't know, maybe they own lots of different partnerships, or maybe they just have salary income from another entity, right? And so when those capital gains or losses or dividends flow through to the different partners, they're going to get taxed at different marginal rates depending on each partner's unique situation. And then those differences are even larger if we have different entity types as partners. So say you have a C corporation that is a partner in a partnership and an individual that is a partner in a partnership. Okay, so we have to pay attention to separately stated items. I'm going to go back for just a second. When we talk about separately stated items, interest income is a common separately stated item. Guaranteed payments, earnings or loss from self-employment, tax-exempt income, investment interest expense, Section 179 deduction, okay, along with capital gains and losses, charitable contributions, dividends. All right. There's a whole list of common ones in the ebook if you want to look at those. But there'll be a bunch of problems that deal strictly with what are separately stated items. Pick out which of these are separately stated. All right, so guaranteed payments. Guaranteed payments are kind of an interesting item. Okay, they are similar to salary payments in that they are treated as self-employment income. Okay. All right. They are separately stated. They're also treated as a deduction for QBI. All right. So they reduce your qualified business income. Okay. They are a fixed amount paid to a partner regardless, and this is kind of important, regardless of the profit or loss earned by the partnership. So if you have a contract for a guaranteed payment, that means that partnership is required to legally pay you that amount, whether or not they're in a profit or loss situation. So guaranteed payments would get paid first, and then profits are distributed after that. Okay? And they are deducted in computing a partnership's ordinary income or loss for the year. So that makes sense. All right. What about self-employment tax? Okay. So there are some it depends rules with self-employment taxes. Okay. So some general rules. All right. Ordinary business income and loss are treated as self-employment by general partners, and they're not treated as self-employment by limited partners. Okay. So you have to pay attention based on the involvement with the organization. Okay. And then this slide here talks about how you go about determining who is a limited partner and who is a general partner, essentially. Okay. So that's pretty helpful. All right. What about business interest expense? All right. So the limitation on the business interest expense, make sure you recognize that this is only an issue if you are a large partnership. Okay. So that would be my first thing to make sure you hone in on, because that's an important item to recognize. The other item that I would call your attention to is what happens to the disallowed interest. Okay. So this disallowed interest is allocated to the partners, and it reduces their tax basis in their interest. Okay. And so it's also available as a deduction at the partner level. Okay. To the extent that they have excess business interest limitation in the future years. Okay. All right. Qualified business income. We've talked about QBI from an individual perspective, right? Now we kind of see where this QBI comes from. When we are talking about individual taxation, the qualified business income flows through to their tax return as a deduction, a QBID, right? But here we have to talk about how do we calculate this qualified business income, all right? So we have to remember that there are items that are not included in QBI, okay? And it's important to know that there are still entity things that have to be done related to QBI, all right? The partnerships still have to disclose information, all right, about each of these QBI calculations. All right, so we also have this net investment income tax, all right? So this is going to include all the partners' share of interest, dividends, annuities, royalties, rents, okay? Any income from a trade or business that's a passive activity, all right? And that's going to be dependent on the nature of the partners' activities in that partnership, right? So it's not going to be a one-size-fits-all for all of the partners, okay? And then each individual partner's share of gains from property that was not used in an active trade or business, okay? All right, and here we have a pretty good list of some common separately stated items. All right, and we've talked about all of those, but this is a pretty good list. All right, what about compliance issues? All right, we've already said that partnerships don't pay taxes, the partners pay taxes, but partnerships, that is, do have to file a tax form, okay? And then each partner gets a K-1 from the partnership, and that K-1 has a list of all the separately stated items, and then all of those items, that's how they flow through, that's how these separately stated items get onto the partner's tax returns, is via this K-1 schedule, okay? All right, every year there are calculations that have to be made, okay? All right, so this slide kind of shows you the adjustments that partners have to make in their partnership interests annually, all right? So let's talk about cash distributions in partnerships, okay? So remember that this is a flow-through entity, so partners are taxed on income when it is earned, right? But not when it's distributed, okay? So if cash is distributed and the partners have a positive tax basis in their partnership interest, then the distribution is essentially one of three items, okay? And so let me write a little bit of this down. If cash is distributed, when the partner has positive tax basis, all right, then the distribution represents a combination of, now it can be only one of these, or it can be a combination of the three. It represents a distribution of profits that have already been taxed, or a return of capital, right, that the partner previously contributed to the partnership, or the distribution of cash that the partnership has borrowed. Okay. Now, if you get a cash basis, or excuse me, a cash distribution in excess of the partner's basis, those are taxable. And this cash distribution can be deemed or actual, all right? In that case, it's taxed, and generally, I'm going to underline generally. They're generally taxed as a capital gain. Okay. What about losses? And we've talked about this in other classes, but losses, right? As long as they're operating losses, can generate current tax benefits, right? Because we know that ordinary losses from partnerships are deductible against any type of taxable income. That's the benefit of being a flow-through entity. Okay. All right. But remember that losses are only deductible when they clear these 4 separate hurdles. Okay. So there are 4 things that those losses have to, 4 tests essentially, that have to be passed in order for those losses to be deductible. Okay. So I'm going to resize things a little bit, and then we'll talk about each of these items just a little bit more. Okay. So tax basis. All right. Partners cannot deduct partnership losses in excess of their outside basis. Okay. Now, what about your at-risk amount? Well, your at-risk amount is more restrictive than your tax basis. Okay. So it means that it has to do with the amount of non-recourse debt that you have. And essentially what it does is limits the amount of losses that you can recognize relative to non-recourse debt. Okay. I'm going to come down here. I want to write a little bit more about at risk. Partners are considered at risk, okay, for amounts equal to the cash and the tax basis of the property contributed to the partnership and recourse debt and qualified non-recourse debt allocated to them. Okay, so partners are considered at risk for okay? All right, plus recourse debt and qualified non-recourse debt allocated to the partner, okay? So at risk is typically more restrictive than basis. Okay, now what about passive activity loss limitation? All right, remember that you can only deduct passive losses against passive income. All right, but then you get to roll any excess loss forward. Okay, and now we have this fairly new, you have this excess business loss limitation. All right. So this is applied after tax basis, after at risk, and after the passive loss limitations. Okay, so it's listed last because it's enacted last. Okay, it applies to non-corporate partners. Okay, and what it says is that business losses from partnerships are limited to business income from other sources plus a threshold amount, okay? And then that threshold amount changes based on filing status and it's indexed for inflation, okay? So let me write some of that down, okay? So this excess business loss limitation, all right, is, business losses from partnerships are limited to business income from other sources plus this threshold amount, okay? And remember, this is only for non-corporate partners, okay? All right, and then we have the final slide is your tests for material participation. I do not expect you to memorize these. You will not have multiple choice questions, you know, expecting you to be able to determine whether someone is materially participating or not. You will be given that information. But it is important to know why we test for material participation, okay? And the reason that we test for material participation is because that is part of what determines whether your interest in a partnership is passive or active, okay? So it's important to know the implications of material participation, all right? That is all I have for Chapter 9.